Ladies and gentlemen, what if the biggest story in gold and silver isn't inflation, interest rates, or even the Federal Reserve? What if it's a geopolitical shift that most investors are completely ignoring? Russia has taken another step that could reshape how global trade, reserves, and capital move across the world. History shows that whenever confidence in the financial system begins to fracture, money doesn't disappear, it simply changes direction. And if you own gold or silver, what happens next could matter far more than the headlines suggest. Let's connect the dots. For years, the public has been conditioned to believe that the global financial system is fixed, permanent, and immune to fundamental change. That assumption has always been historically incorrect. Every major monetary system eventually reaches a point where confidence begins to shift, and once that process starts, the movement of capital becomes far more important than political statements or media narratives. The real force behind history has never been ideology alone. It has always been the migration of money toward what investors perceive as greater safety and stability. What we are witnessing today is another stage in that long historical cycle. Nations are increasingly searching for alternatives that reduce dependence on a financial framework dominated by a single center of influence. This does not mean the existing system disappears overnight. History never works that way. Monetary transitions unfold gradually, often taking years or even decades before the majority finally recognizes what has already been happening beneath the surface. One of the greatest mistakes investors make is assuming that financial power changes through dramatic announcements. In reality, it changes through countless small decisions made by governments, central banks, institutions, and multinational corporations. Each decision may appear insignificant on its own, but together they slowly redirect the flow of global capital. That is precisely how every major financial transformation has unfolded throughout history. Confidence is the true currency of every monetary system. Paper money has value because people believe others will continue accepting it tomorrow. Government debt functions because investors maintain confidence that obligations will be honored. International reserve currencies dominate because global markets trust their liquidity, legal protections, and financial infrastructure. Once confidence begins to diversify rather than disappear, capital naturally starts exploring alternatives. Many analysts continue focusing almost exclusively on inflation reports, interest rate decisions, or quarterly economic data. Those indicators certainly matter, but they often distract investors from the larger structural changes occurring underneath. Markets are forward-looking. Capital moves long before economists adjust their forecasts. By the time the consensus finally recognizes a new trend, institutional money has frequently been positioning itself for years. History repeatedly demonstrates that geopolitical tension accelerates financial innovation. Countries facing uncertainty rarely wait for permission to protect their economic interests. They develop new payment mechanisms, expand bilateral trade agreements, diversify reserve assets, and strengthen relationships outside traditional channels. None of these developments individually overturn the existing order. Collectively, however, they reduce concentration and gradually reshape the global financial landscape. The important lesson is that diversification is not necessarily an attack on one currency or another. It is often simply a rational response to uncertainty. Governments, like private investors, prefer flexibility. They seek multiple options rather than complete dependence on a single financial pathway. That behavior has been repeated throughout centuries of economic history. This is why watching capital flows provides a much clearer picture than following emotional headlines. Headlines are designed to capture attention. Capital seeks opportunity and preservation. Those two objectives are rarely aligned. Investors who react emotionally to every political development often find themselves buying and selling at precisely the wrong moments. Meanwhile, large institutions quietly adjust portfolios based upon long-term risk assessments rather than daily news cycles. We should also recognize that financial systems become increasingly interconnected during periods of globalization, but they can just as easily become more regionalized when political risks increase. Trade routes adapt, investment patterns evolve, reserve allocations change gradually. None of this requires a sudden collapse. Markets constantly adjust to changing incentives without dramatic public declarations. Perhaps the biggest misconception is the belief that only weakness drives demand for alternative assets. In reality, uncertainty itself often encourages diversification. Investors do not necessarily abandon one market entirely. Instead, they spread exposure across multiple regions and asset classes to reduce overall risk. This subtle shift can produce significant long-term consequences because enormous pools of institutional capital are involved. The same principle applies to sovereign reserve management. Central banks rarely make emotional decisions. Their objective is stability over decades, not weeks. When they gradually adjust reserve compositions or increase holdings of tangible assets, those actions reflect strategic thinking rather than speculation. Such adjustments may appear slow, but they accumulate over time into meaningful structural changes. History also teaches that monetary transitions are rarely clean or predictable. Multiple systems frequently coexist during lengthy periods of adjustment. The established financial order continues functioning while alternative arrangements expand simultaneously. Investors expecting a dramatic overnight replacement misunderstand how history unfolds. Financial evolution resembles a slow shift in tectonic plates rather than a sudden earthquake. That is precisely why patience becomes such an important investment advantage. The public naturally searches for one defining event that explains everything. Markets rarely offer that simplicity. Instead, trends emerge through hundreds of interconnected developments, each reinforcing the next. By the time the evidence becomes overwhelming, the opportunity to position early has often disappeared. Ultimately, the issue is not whether the current financial order survives tomorrow. That is the wrong question entirely. The more relevant question is whether confidence is becoming more diversified across the global economy. If the answer is yes, then capital will continue adjusting accordingly, regardless of political rhetoric or media narratives. The investors who understand this distinction avoid becoming trapped by short-term emotional swings. They recognize that financial history moves in cycles driven by confidence, capital mobility, and changing perceptions of risk. Those forces have shaped every major monetary transition for centuries, and there is little reason to believe the present era will prove any different. Watching where money quietly flows will almost always provide a clearer guide to the future than listening to the loudest voices attempting to explain it. One of the biggest mistakes investors make is believing that gold and silver move simply because people become frightened. Fear certainly creates short-term volatility, but it does not sustain long-term bull markets. Markets are driven by capital, not emotion. While headlines can trigger temporary spikes or sharp corrections, the lasting direction of any asset class depends on where large pools of money decide to relocate. Understanding that distinction separates those who react to news from those who recognize the underlying cycle before it becomes obvious. History consistently demonstrates that financial markets are interconnected. Money rarely sits still. It constantly searches for the highest combination of security, liquidity, and opportunity. When confidence in one sector begins to weaken, capital does not vanish. It simply migrates elsewhere. That migration often occurs quietly, long before the average investor notices a change. By the time newspapers begin declaring that a new trend has arrived, institutional investors have frequently been repositioning their portfolios for months or even years. This is why watching capital flows provides a far more reliable framework than attempting to measure public sentiment. Fear is difficult to quantify and often changes overnight. Capital allocation, on the other hand, leaves a trail. Bond markets, equity markets, currency markets, and commodity markets constantly interact with one another. None of them operate in isolation. A shift in one area eventually influences the others because the same institutional money participates across multiple asset classes. Many investors still approach precious metals as though they exist in a separate universe. They imagine that gold and silver rise only when every other market is collapsing. History offers a much more complicated picture. There have been numerous periods when metals appreciated, while equities remained relatively strong. There have also been times when both declined together as investors sought liquidity. The relationship depends not on simplistic narratives, but on the broader movement of global capital. This is precisely why relying on traditional assumptions can become dangerous. Markets evolve as economic conditions change. Investment strategies that work perfectly during one decade may fail during the next because the underlying structure has shifted. The world economy is dynamic, not static. Investors who continue applying outdated formulas eventually discover that history never repeats in exactly the same way. It often rhymes, but the details are always different. Another misunderstanding involves the role of the dollar. Many commentators insist that precious metals require a weak dollar to perform well, yet history has shown periods when both the dollar and gold advance simultaneously. At first glance, it appears contradictory, but it becomes entirely logical once capital flows are understood. During times of elevated global uncertainty, investors may seek both the liquidity of the dollar and the perceived long-term stability of tangible assets. These are not mutually exclusive destinations for international capital. The same principle extends to silver. Although silver possesses important industrial applications, it also behaves as a monetary asset during periods of changing confidence. This dual nature means its performance can differ from gold over shorter intervals, yet both remain connected to the larger process of capital migration. Investors who examine only industrial demand or only inflation forecasts often overlook the broader financial forces influencing long-term price trends. Large institutional investors rarely make decisions based on television commentary or sensational headlines. Pension funds, sovereign wealth funds, insurance companies, and central banks evaluate systemic risk over extended time horizons. They monitor geopolitical developments, sovereign debt trends, banking stability, currency exposure, and global liquidity conditions. When these participants begin adjusting portfolios, the resulting capital movements can influence markets far more than short-lived emotional reactions among retail investors. It is equally important to understand that markets anticipate change. Prices rarely wait for certainty. If investors insist upon complete confirmation before acting, they frequently enter trends after much of the movement has already occurred. Capital begins repositioning when probabilities shift, not when outcomes become guaranteed. This forward-looking characteristic explains why markets sometimes appear disconnected from current economic data. They are discounting expectations rather than simply reflecting present conditions. Another lesson repeated throughout financial history is that diversification becomes increasingly attractive when uncertainty expands. Investors do not necessarily abandon productive assets. Instead, they broaden exposure across multiple regions, currencies, and asset classes. Precious metals often benefit from this process because they represent financial assets without direct dependence on any individual government's fiscal position. That characteristic has attracted capital through countless historical cycles. Short-term price fluctuations should therefore be viewed within a much larger context. Markets never move in straight lines. Corrections, rallies, periods of consolidation, and unexpected reversals are all natural components of longer-term trends. Investors who become emotionally attached to daily price movements often lose sight of the structural forces developing underneath. The larger story frequently remains intact even while short-term volatility creates confusion. Perhaps the greatest advantage belongs to those willing to observe the broader cycle rather than attempting to predict every immediate market reaction. Capital does not announce its intentions through headlines. It reveals itself through persistent changes in asset allocation, reserve management, international investment patterns, and institutional behavior. Those signals often provide more valuable insight than any individual economic report or political speech. The financial world has always operated according to cycles of confidence. As confidence strengthens in one area, capital concentrates there. As confidence becomes more diversified, money gradually spreads across alternative opportunities. This process is neither emotional nor ideological. It is practical. Investors seek preservation first and return second. That hierarchy has remained remarkably consistent across centuries of financial history. Ultimately, the future direction of gold and silver will not be determined by fear alone, nor by a single economic statistic, election, or geopolitical event. Their long-term trajectory will be shaped by the continuous movement of global capital, responding to changing perceptions of risk, opportunity, and confidence. Those who understand where money is flowing, rather than becoming distracted by where headlines are pointing, place themselves in a far stronger position to recognize the next major trend before it becomes common knowledge. The greatest opportunities in financial history have rarely appeared obvious at the time they emerged. In fact, the defining characteristic of nearly every major market trend is that the majority fails to recognize it until much of the move has already taken place. Human nature encourages people to seek certainty before taking action, but markets reward those who understand probabilities rather than waiting for universal agreement. By the time every headline points in the same direction, the easy money has often already been made. This is one of the oldest lessons in economics. Capital does not wait for public opinion to catch up. Large institutional investors, multinational corporations, and central banks constantly evaluate long-term developments that extend far beyond quarterly reports or daily news cycles. They understand that structural changes begin quietly. The first signals rarely attract widespread attention because they often appear insignificant when viewed individually. Only in hindsight do people connect those seemingly unrelated events into a single recognizable trend. History provides countless examples of this process. Every major financial transition initially looked temporary. Investors dismissed early warning signs because they believed the existing system would simply return to normal. That assumption is understandable because people naturally expect the future to resemble the recent past. Markets, however, rarely reward that kind of thinking. The world changes gradually until suddenly everyone realizes it has already changed. One reason this happens is that financial markets are forward-looking. Prices reflect expectations, not just present conditions. Investors often become frustrated when markets move in ways that appear disconnected from current economic data. In reality, markets are attempting to discount future developments before they become obvious. This explains why significant rallies or corrections frequently begin while economists continue debating whether conditions have actually changed. Another common mistake is believing that trends require dramatic announcements to begin. Most do not. Instead, they develop through a long sequence of incremental decisions. Institutions adjust portfolio allocations. Governments revise economic priorities. Central banks modify reserve strategies. International businesses diversify supply chains and investment destinations. Each individual decision may appear minor, yet together they create a powerful shift in the direction of global capital. The average investor rarely notices these gradual adjustments because media attention naturally focuses on immediate events. Political debates, economic releases, and market volatility dominate headlines because they generate daily interest. Structural changes receive far less coverage because they unfold over extended periods. Yet those slower developments frequently determine the next decade of market performance far more than any single news event. Understanding this difference changes how investors interpret volatility. Sharp price movements often distract participants from the broader trend rather than defining it. Corrections become viewed as evidence that the long-term story has failed, when in reality they are often a normal feature of every sustained market cycle. No asset moves in a perfectly straight line. Periods of uncertainty, consolidation, and temporary reversals have accompanied virtually every major advance throughout financial history. This is why patience remains such an underrated investment skill. Modern markets encourage constant activity. Investors are surrounded by endless opinions, predictions, and breaking news alerts suggesting immediate action. Yet history repeatedly demonstrates that excessive trading frequently produces poorer results than disciplined positioning based upon long-term structural analysis. The objective is not to react faster than everyone else. It is to recognize the larger direction before it becomes obvious. Psychology also plays an enormous role in market behavior. Most individuals feel comfortable buying assets only after prices have already risen substantially because public confidence has increased. Ironically, that is often when risk begins expanding rather than contracting. Conversely, periods of uncertainty frequently produce the greatest opportunities because pessimism discourages participation precisely when long-term value is improving. Markets consistently reward independent analysis over emotional consensus. Institutional capital understands this principle well. Large investors rarely commit substantial resources because a trend has become popular. They seek opportunities where future expectations differ from present pricing. Their objective is to identify developing imbalances before they attract widespread attention. Once public enthusiasm reaches its peak, sophisticated investors often become more cautious because valuations increasingly reflect optimistic assumptions. Another important lesson is that markets do not require unanimous participation to establish powerful trends. In fact, the strongest advances often begin while skepticism remains widespread. This occurs because relatively small shifts in institutional capital can create significant price movements long before retail investors become involved. As confidence gradually expands, additional participants reinforce the existing direction, creating momentum that appears obvious only after considerable progress has already occurred. The broader economic environment also supports this pattern. Financial systems continually evolve in response to changing demographics, technological innovation, fiscal policies, debt dynamics, and international capital movements. These forces develop over many years rather than weeks. Investors who focus exclusively on short-term economic indicators frequently overlook the deeper structural currents shaping future market behavior. Successful investing, therefore, requires distinguishing between temporary noise and meaningful transformation. Not every headline deserves equal attention, not every market decline represents disaster, and not every rally signals lasting prosperity. The real challenge lies in identifying whether current events merely create short-term volatility or whether they reinforce a much larger shift already underway. Perhaps the most valuable insight is that opportunities rarely announce themselves with complete clarity. Uncertainty is not the enemy of investing, it is often the source of exceptional returns. If every outcome were guaranteed, prices would immediately adjust to reflect that certainty, eliminating much of the potential reward. The willingness to evaluate probabilities instead of demanding perfect confirmation has distinguished successful investors throughout history. Ultimately, the market does not reward those who follow the loudest opinions. It rewards those who recognize changes in confidence and capital allocation before they become universally accepted. Every major cycle begins quietly, gains strength while skepticism persists, and reaches widespread recognition only after substantial progress has already been made. Those who understand this recurring pattern are better prepared to identify opportunity, while others remain focused on yesterday's assumptions. In every era, the majority eventually recognizes the trend, but by then, the market has usually moved far ahead of them.